Hi guys, today we discuss interest rates effects and solutions. So firstly we discuss high interest rates. Certainly. When the Federal Reserve decides to raise interest rates, it is a calculated decision made with the intention of affecting the state of the economy as a whole. Let's learn more specifically about the Federal Reserve rate increase. Our first point is increased borrowing costs. Borrowing money costs more and interest rates increase for everyone, for people, for businesses, and even for the government. Because rising borrowing prices may discourage people and firms from taking on new debt or making significant investments, this may result in a decline in borrowing and expenditure. Spending and borrowing less can cause the economy to grow more slowly. Second point is impact on investments. In financial markets, a rate increase may have a big effect. As investors look to fixed income products like bonds for higher returns, the price of stocks could fall. With rising interest rates, bond values may also decline as investors turn to new bonds with higher returns. Overall, a rate increase may cause the market to become more volatile and cause investors to alter their investment plans. Third point is impact on mortgages and loans. Higher interest rates may have an impact on mortgage rates, increasing the cost of property purchases or mortgage refinancing for consumers. As a result, the housing market could slow down because prospective purchasers might be discouraged by increasing borrowing costs. Similar to how credit card interest rates could increase, borrowing prices for auto loans, personal loans, and credit cards could too affect consumer borrowing and expenditure. Fourth point is impact on currency exchange rates. The Federal Reserve may raise interest rates in order to attract more foreign capital to that nation's currency. The demand for the currency may rise as a result of rising interest rates since investments denominated in that currency will offer higher returns. On the foreign exchange market, the currency's value may rise in relation to other currencies as a result of this increased demand. Fifth point is impact on inflation. To combat economic inflationary pressures, the Federal Reserve frequently boosts interest rates. The Fed wants to curb spending and stop the economy from overheating by raising borrowing prices. Higher interest rates can lead to decreased consumer spending and business investment, which can help moderate inflationary pressures. It is significant to remember that the entire effects of a Federal Reserve rate increase might change based on a number of variables, such as the state of the economy at the time, market conditions, and other world events. It's possible for the consequences to be complicated and not always instantaneous or linear. As a result, it is critical that economists and politicians consider all potential repercussions before raising interest rates. Now, we discuss what are solutions. The survival of the general public in the context of a Federal Reserve rate hike depends on various factors, including the state of the economy, individual financial situations, and preparedness. Here are some broad suggestions for the public, even though a rate increase can have both positive and bad effects. Our first point is personal finances. The cost of borrowing may increase when interest rates rise. People should consider their financial condition and the potential effects of increasing interest rates on their credit cards, loans, and mortgages. Individuals can handle the potential difficulties of rising borrowing prices by setting a budget, keeping track of their debt, and looking into refinancing or debt consolidation possibilities. Second point is investments. Investment portfolios may be impacted by a rate increase. Bond prices may fluctuate, and stock prices may be volatile. Individuals may weather market volatility and make wise financial decisions by diversifying their investments, getting professional assistance, and establishing a long-term investment strategy. Third point is housing market. Higher interest rates can impact the housing market, particularly mortgage rates. Prospective homebuyers should think about how rising rates would influence their capacity to purchase a property or meet mortgage qualifications. For homeowners, it may be crucial to consider how increased rates may affect their current mortgages and determine whether refinancing choices are advantageous. Fourth point is consumer spending. A rate increase might have an effect on consumer expenditure. Spending less on large-ticket products like homes, vehicles, and other substantial purchases could result from higher borrowing prices. During times of rising interest rates, people may need to modify their spending patterns and give priority to necessities. Fifth point is savings and investments. Higher interest rates can benefit savers by increasing the yields on savings accounts, certificates of deposit, CDs, and other fixed-income investments. People may want to look into choices for investing and saving that offer larger returns in reaction to rate increases. People must be aware of current economic developments, seek out expert counsel when necessary, and modify their financial plans as necessary. Additionally, having a solid financial foundation through emergency funds, wise budgeting, and debt management can help people face any difficulties brought on by a Federal Reserve rate hike. Thank you so much for watching this video. Please subscribe our channel.